Good afternoon, everybody, and welcome to our TSP Tax Update webinar of 11 December 2024. My name is Jeff Webber. I'm one of the tax line consultants, and I'll be chairing the webinar. And I'll also be presenting the brief direct tax news items just before my VAT colleague will be presenting the tax news items on indirect taxes. Our main speakers today are Gemma Davies, a director in our private client group, who will be talking about philanthropy. And the second main topic will be presented by my tax line colleagues, Chris Holmes and Sadiq Hashmi. Many of you may have spoken to them on the tax line. They will be covering the thorny topic of close company loans to participators. This is a tricky area, of course, where clients don't always tell you in advance what they've been doing. And Chris and Sadiq will be looking at the legislation and the practicalities. There'll be time for questions and answers immediately after each session, and also a little time at the end of the webinar. I should also mention that we will not be having a webinar in January, when everyone will be very busy, of course. So our next webinar will be on the 12th of February, when we have penciled in talks on luxury assets and also on employer year-end issues. The invites for this will normally go out in January. So can we have the next slide, please? These are our speakers, myself and Rob dealing with the brief news, Gemma, Sadiq and Chris dealing with the main topics. Next slide, please. There's the list. Next slide, please. That's myself and Rob dealing with the news items. Next slide, please. These are the direct tax topics that I'm very briefly dealing with. As I'm sure you're all aware, there's not been a huge amount of tax news recently, apart from the fallout, of course, from the 2024 autumn statement. I'm sure you're all aware that everybody is focusing on IHT, with the difficulties raised by people affected by the reduction in agriculture relief and business relief. As I'm sure you're all deeply into this already, all I would mention is that our experience is that at the moment, with regard to IHT planning, a lot of people are considering either PETs, potentially exempt transfers, while the going is good, or possibly transfers out of normal income to sidestep IHT altogether. One thing I should mention is that as far as pets are concerned, although the legislation has not yet been published, we are told that there will be anti-forestalling in it, so that pets made between now and the 6th of April, where the donor dies within 7 years after the 6th of April, will be caught as failed pets under the new IHT rules. So agricultural relief and business relief in those circumstances would be restricted. The other points I was going to cover in the direct tax news update are a few very interesting recent tax cases. The first one I wanted to mention was an SDLT group relief case, the Tower 1 St George Wharf Limited case, which went to the upper tribunal. And this illustrates the fact that SDLT group relief has its own anti-avoidance, so that if an intra-group transaction of English or Northern Irish real estate is made within a group, wholly or mainly for tax avoidance purposes, the built-in SDLT group relief anti-avoidance will catch it, and the revenue don't have to rely on the Section 75A mini GAR. Another case worth mentioning is the recent case involving the Harry Potter actor Rupert Grint, in a case that was heard by the first tier tribunal, where he transferred his business as such to a limited company in return for cash. And HMRC decided to challenge this on the basis that although it was transferred as a going concern, it was wholly or mainly for tax avoidance purposes. And unfortunately, all the advisors' emails and other documents supported the fact that it was entirely tax driven. So the lesson here is great care is needed with the advice. If you are advising a client to incorporate their business, and the amounts likely to be involved are large, as in the case of a successful actor. Another interesting case concerned R&D. The case was Stage 1 Creative Services, where this was fortunately another win for the taxpayer. The argument that the revenue was put forward is that where R&D is done for a specific piece of work that is paid for, it's caught under the rules prohibiting R&D relief for subsidized expenditure or contracted expenditure. The tax tribunal considered the case in the round and felt that the revenue's interpretation was too restrictive and should not be supported. Now, this is the second recent case, but so far HMRC have not appealed to the upper tribunal. So the first tier tribunal, unfortunately, does not set a legal precedent, although it is of illustrative value. So I would say if you run into arguments like this with HMRC about R&D, do give us a call. We've got a very large R&D specialist department here who may be able to help with the argument. At that point, I'll hand over to Rob. So next slide, please.
Good afternoon, everybody. So just some 3 quick updates from a VAT perspective. So the first one is just an update on the hotel at all case. So you may remember this is quite an important case to do with the input VAT recovery on legal and professional fees. So it's to do with the fact that Hotel Latour Limited sold off their subsidiary Hotel Latour Birmingham to finance the building of a new hotel in Milton Keynes. Now, just as a quick reminder, the first tier tribunal said that yes, you can have the input VAT recovery because you actually it's a cost component of the downstream VATable activities, because it's funding the downstream VATable activities. And the upper tier tribunal agreed with the first tier tribunal as well in 2023. And then earlier this year, the Court of Appeal reversed the decision very quickly. Only took 2 weeks to come out with a judgment. And they said that no, because it directly relates to a exempt share sale. It means that you can't have the input VAT recovery, which is certainly the old position. But because of more recent cases, it's certainly the feeling that the Court of Appeal have got their decision wrong. And the update really is to say that the Supreme Court has now granted leave to appeal to Hotel Latour. And we're expected to have the appeal sometime next year. We haven't got a date set yet. But just as a reminder, it's quite important. So if you have got clients where they say selling off shares or subsidiary to finance other VATable activities in the business and the rest of the business, then it could mean that input VAT recovery, where say 20, 30 years ago it wouldn't be allowed because of the then case law, it could now be allowed. And potentially for other exempt transactions, so for instance, if you sell a property that's VAT exempt, then with the purpose and the clear evidence to show that the funds are going to be used to fund the VATable activities of the business, then possibly it can also mean that those legal and professional fees can also be reclaimed. The second one is two updates from HMRC guidance, or second and third, two HMRC guidance updates. So the first one regards pre-registration input VAT claims. So this has particularly come about because of obviously the new the VAT on, or removal of the exemption on the private school fees. So if you remember that on goods, if you can reclaim input VAT paid on goods if it's less than 4 years before the registration date, and the goods are still on hand at the date of registration. And for services, you can reclaim it if it's incurred within 6 months of the registration date. And what HMRC have done is basically updated it to say that you don't need to reduce the input that you are claiming unless those goods have been used to make previously exempt or non-business supplies. So, obviously aimed at private schools, because up until 31st of December, all the private school fees will be exempt. And the idea is HMRC will require an apportionment based on the economic life of the goods. So goods generally HMRC say, have an economic life of 5 years. And the apportionment is time-based, based on months, so the number of months used to make exempt supplies, the number of months to make taxable supplies. And although it is aimed at schools, it could have wider implications for other businesses. And the third one, sorry, is the updates to transfer of going concern guidance. So if you remember that one of the key conditions for the TOGC treatment to apply is that if the seller is a taxable person, the buyer must also be a taxable person. And the majority of people, certainly I see this, a lot of people say, well, that means you just got to be registered with VAT. So if the seller's registered with VAT, the buyer has to be as well, which isn't quite correct, because a taxable person in the VAT law is defined as yes, someone who is registered with VAT, but also someone who's required to be registered with VAT, i.e. they've breached the VAT registration threshold, either in the previous 12 months, or will do in the next 30 days alone. And the guidance is basically an update just to make sure everyone is aware of this. And it's been updated to show that when you're looking at the turnover of the business that's been sold, you look at the previous 12 months to the transfer. Or if it's just a part that's been transferred, that part of the business in isolation. And you remember that VAT law means that if you buy a business, you inherit the turnover history. So it means that if the buyer is going to be over the VAT registration threshold at the time of the transfer based on the previous 12 months turnover, they will be a taxable person. And also, the guidance also has been updated to show that if as a buyer, you must include the value of previously made taxable supplies in the previous 12 months. So say, for instance, that the turnover from the business you're buying is £50,000 and the buyer's already turned over £50,000. At the time of the transfer, they will be a taxable person. So it's just important to remember that for transfer of going concern purposes, the buyer does not necessarily have to be registered with VAT at the time of the transfer. The requirement is that they are either registered or they are required to be registered based on the turnover history of the business that they are purchasing. Okay, Jeff, that's me done. Back to you.
Okay, can we have the next slide, please? All right. I can't see any questions coming in so far, so I assume we can now move on to our next speaker. That's Gemma Davies. Next slide, please. Over to you, Gemma.
Thank you, Jeff. Yeah, so I'm Gemma Davies, and as Jeff mentioned, I'm a director in the private client team in London. My primary focus is helping multi-generational families with their succession planning, and increasingly this includes discussions around philanthropy, which is why I'm here speaking to you today. So next slide, please. Right, so there were no significant changes to reliefs for individuals in relation to charitable giving in the autumn budget. The latest significant change being the one announced in Finance Number 2 Bill 2023, which amended the definition of charity, restricting it to UK charities only, and that announcement took immediate effect. I'm going to quickly run through that, although it was last year. I'm going to quickly run through it as it could well have an impact on sort of 23-24 tax returns being prepared now, and obviously has an ongoing impact for taxpayers. So from 15th of March 23, only a charity that comes within the jurisdiction of the High Court in England, Wales or Northern Ireland, or the Court of Session in Scotland will qualify for UK charitable reliefs. And CSCs must be based in the UK and provide facilities for eligible sports in the UK to qualify for charitable relief. As I said, the changes took immediate effect, but there were some transitional provisions for EU and EEA charities that had previously asserted their status for charitable tax relief with HMRC. They had to have done that prior to 15th of March 2023. And then that transitional period meant the changes didn't take effect in respect of gifts to them until April, up until 5th of April 24. So next slide, please. So who did this impact? So the main impact here obviously was EU and EEA charities that had been claiming gift aid or tax relief, individuals making donations to these charities and claiming relief, and companies making donations to those charities. So looking specifically at individuals, any that were or are donating to EU and EEA charities lost or will lose access to UK income tax, capital gains tax and inheritance tax relief. And it's actually the latter of these that's potentially overlooked the most, because as the gifts are no longer exempt for IHT, then unless they qualify for another IHT relief or are within the annual £3,000 exemption, then they could be chargeable lifetime transfers. So that would give rise to an immediate 20% inheritance tax charge. Additionally, if there's a legacy to a non-UK charity that's been written into a will, these could give rise to IHT of 40% on death. So if we go to the next slide. Thank you. So what sort of action should clients be taking at this point? So having a look at if they've been making donations to EU and EEA charities, then they would need to consider whether the donations continue to qualify for tax relief in the 23-24 tax year, in order to make that claim on their 23-24 tax return. So UK taxpayers had to evidence the asserted status in order to make that claim. Non-DOMs may have been making donations offshore to prevent any sort of remittances. Again, these would need to be reviewed to see whether any charges arise, and obviously as an ongoing, with all the non-DOM changes and everything else, they'd have to be thinking about what donations they're making. There are options though, if they wanted to consider carrying on supporting those non-UK charities. Things like establishing or giving to an existing UK charity, or particularly things like a UK Friends of. Quite often we have those, so that would still get the ultimate benefit going to that offshore charity, but still maintaining that UK relief. Donating to a donor advised fund, and I'm going to talk a little bit more about those in a bit. And then for US citizens or green card holders, looking at dual US UK qualifying charities. So that's kind of the tax update piece. If we can go to the next slide, I've got a nice festive quote. Yeah, as we head towards the Christmas season, this is a quote from the author of Rip Van Winkle, also wrote The Legend of Sleepy Hollow. But it's just kind of a little bit about why we should be talking to our clients about philanthropy and what I've sort of seen from my experience. Basically, in the last 10 years, we've seen a rise in philanthropic giving, and we're seeing newly wealthy increasingly use their wealth and business experience to create private foundations or startups, or support emerging models in philanthropy and social impact investing. Wealth holders, particularly younger generations, are increasingly seeking to align their wealth with their values. They expect their advisors to be able to provide professional support in numerous, increasingly complex areas, which includes philanthropy. From us, we're seeing clients want advice on the tax and how to give tax efficiently, and how to make a positive impact with their wealth. So include, and also by including philanthropy in conversations with clients, you often address areas in their life where they're really passionate. So it kind of broadens the relationship with them, which is a really great way to sort of build that relationship. But aside from kind of topical issues, such as the definition change I just mentioned, or the IHT announcements that Jeff mentioned earlier that could lead to wider succession planning discussions, it's worth thinking what else might prompt a conversation on philanthropy. So I tend to find that philanthropy conversations can happen at any time. But there are kind of natural moments where we can introduce questions about charitable giving and their intentions. So if a client has a liquidity event, such as the sale of a business or an inheritance, whilst they're drafting or revisiting a will and looking at what legacy giving they might be thinking about, where they've got a life event, such as retirement, marriage, birth of children, birth of grandchildren, or even just part of the sort of general conversation during an annual client meeting. All these are really good ways to kind of explore that kind of the client's motivations or their intentions or kind of their general opinion on philanthropy and whether that needs to form part of their wider kind of succession planning or tax structuring or whatever it might be. So if we jump to the next slide, there you go. So I find there's often three parts to any philanthropy conversation. The first one's not on the slide, but that's kind of what do clients care about? What do they support? What do they want to give back to? Sometimes this might seem like an intimidating question to bring up, but it can really help find out more about client motivations, their values, etc. And it also could be a really good window into the next generation. And as I mentioned, sometimes it's the next generation that is using their influence and their kind of conversations within the family to kind of really think about actually what's the purpose of our family's wealth and what's the purpose and does it align with our values and everything else. So once you've kind of had that conversation, the second part is normally like how will my philanthropic giving be structured? And it's really helpful to talk through these options really early on and sort of really base these options around their long-term philanthropic objectives. And then thirdly, the what are they planning to give, and therefore what are the tax considerations associated with those gifts? Are there tax reliefs available? Do they qualify for income tax relief, capital gains tax relief? Obviously, if it's UK charities, we've got the inheritance tax exemption. So if we just stick to the how first, the easiest and most straightforward method of giving is just a gift to an existing charity. And this is always the way that I would approach clients, is why would you want a new complicated structure or to overcomplicate things if there's a charity out there doing exactly what you want it to be doing and achieving your objectives, your ultimate objectives altogether. So they're normally quite straightforward, cash gifts or a gift of an asset, and you can still ring fence an ultimate cause or project that charity is involved in if that's suitable, but they're by far the easiest and quickest ways of getting the wealth into the charitable sector. However, sometimes the client is looking for a more long-term option for structuring their giving, or they might have a liquidity event, like I mentioned, like a sale of a business, and they're about to come into a significant amount of wealth, and they want to kind of capture that tax relief immediately whilst they've got that high year of tax that then might drop off if they're not likely to be earning or anything in the following years, but haven't actually had the time whilst selling that business to sit back and think about where they ultimately want the funds to go, what charities they want to benefit and things like that. So they'll be looking to try and crystallize that tax relief early, but then give a bit more time and thought or discussion with the family around where the ultimate funds will end up. So things like CAF account, again, they're a fairly straightforward way of getting money triggering that tax relief and having it in effectively a bank account that then is used for making donations. using a private or family charity. Historically, these were fairly common and regular, but I think the increased scrutiny by HMRC and the increased scrutiny by Charity Commission, and the burden that is put on the trustees, there's a bit more of a move away from these and a move towards something like a donor advised fund. And we're definitely seeing these as being increasingly popular with clients, and definitely a conversation to be having. So if I go to the next slide, I'll give you a quick overview of a donor advised fund for people that aren't so familiar with them. So a donor advised fund, or a DAF, as they're commonly referred to, are vehicles for charitable giving that are administered by a third party, and they're designed as a middle ground for clients between sort of direct giving to individual charities and establishing their own foundation. So this is a nice sort of middle ground area to be in. There's a variety of different providers. These are known as the sponsor organisation. And these are banks or independent specialists that are available, and they will suit most donors' needs, whether that's from an employee payroll vehicle or to a multi-million-pound fund that the donor's looking for. A fee is charged for the setup and then for the ongoing administration of the DAF. So unlike a private charitable foundation, because DAFs are operated by the sponsor organisation, the donor doesn't need to find their own trustees, think about trustee changes and training and liability and things like that. They don't need to register with the Charity Commission because they use the umbrella fund. The donor advised fund itself is the registered entity, and they don't need to deal with any of those ongoing administrative aspects and the governance and the reporting and the filing and the due diligence and all the other time constraints that come on trustees of private charities. The DAF itself is fairly easy to set up and to use, and with a cash donation, it can be possible to set up within a matter of days. So it's really useful if you're trying to get something in place either before an end of a tax year or in quite a short space of time. The sponsor organisation will have standardised paperwork to cover most situations, and the donation to the charity occurs immediately on the transfer to the DAF. That's both legally and for tax purposes. We tend to recommend our clients to, although they're standard documents, we'd still recommend the family lawyer just looks over them and make sure they're happy with them. But normally, like I say, it's a fairly quick process. Sorry, a DAF can be funded through cash donations, through payroll giving, gifts of shares or other assets. Quite often the DAF, depending on their risk profile, they will most likely sell those assets. So if you invest a portfolio, gift a portfolio of shares, they will probably liquidate that portfolio, and then depending on what the long-term objectives are with the DAF, they may well invest. The DAF provider would then set up an investment portfolio. So once transferred into the DAF, the value sits within its own fund until the donor advises of or makes recommendations on the charities they would like to benefit. This can be done over a period of time and can be any number of charities that can ultimately benefit both in the UK and overseas. So again, this is a great way of individuals who previously did make donations to EU or EEA charities still being able to do so without causing any adverse IHT implications and things like that. If the money's likely to be sat in the DAF for a while, so if there's a large sum that's put in there and you're only thinking of doing it on a few donations a year, or maybe even having a short period where you're trying to really find those causes to support, then it is possible to establish an investment portfolio. So the market growth and investment income will continue to grow within that charity, so it's exempt from tax. Each provider will have their own rules about how the investment management works in practice. So some DAFs, as I mentioned, are provided by banks who would probably use their own investment managers, whereas others, the more independent ones, and depending on the size of the fund that's being put in, may allow the donor to recommend or use their own family investment managers. A lot of the DAF providers also provide additional advisory services, so they can help develop the donor's charitable strategy, identifying suitable charities and helping them manage that grant process for them. As I mentioned, there's a fee for that ongoing administration, and they'd obviously charge a fee if there was additional advisory services. And normally the fees are based on the value of the assets within the DAF or the time associated with managing and administering it. So for tax purposes, the income and capital gains tax considerations are exactly the same as a gift to any other UK registered charity. And outright lifetime gifts to DAFs of cash, shares or other assets are exempt from inheritance tax. And as I mentioned, these are getting increasingly popular in the UK just because it just takes that governance burden off the individual, and they don't have to do all the due diligence on those charities, the ultimate charities and things like that, because the sponsor organisation will do that for them. So that was my whistle-stop tour of DAFs and sort of those philanthropy conversations, which hopefully was useful. I think my next slide is probably, are there any questions? There you go.
Yeah, I can't see any questions coming in online.
Okay.
Now's your chance if you do have any. If not, I think we'll move on to our final talk of the day, which is Chris and Sadiq on closed company loans to participators. So next slide, please.
Thanks, Jeff.
Thank you. I'll let Sadiq take over. He's starting, so.
Cheers, Chris. Yep, so if you go on to the next slide, I'm just going to cover some of the basics and some background, and then Chris is going to go into some of the nuances. So good afternoon, everyone. So firstly, what is the Section 455 charge? Well, it's a temporary corporation tax charge which closed companies have to pay on loans outstanding to participators or an associate of a participator. So just a quick background, a closed company is a company controlled by 5 or fewer participators, or any number of participators who are directors in a company. The rate of the Section 455 charge equals the higher dividends rate, which is 33.75%. Note it's not the same as, note the rate isn't the additional rate, but the higher rate. The definition of a participator is quite broad and quite wide. So as well as shareholders, it also includes loan creditors and persons entitled to acquire shares. And it could also be for participators of another company which is under common control. So if company A controls company B, then any participator of company A could also be considered as a participator of company B. And it also includes associate of participators, which includes relatives or settlers of trusts. So the rules are quite wide-ranging, and it's a 33.75% charge. If you go on to the next slide. Just going to discuss how the charge actually works. So the charge applies to any participator, as it already explained, and it applies on the loan outstanding at the end of the accounting period and the loan that remains outstanding after 9 months after the accounting period. So it's actually reported at the same time as a company pays corporation tax. So it's alongside the tax return, and it's payable 9 months and 1 day after the accounting period. And you can get a refund of the amount paid after you repay the loan, or if the loan is waived. So if you look at this example, it all makes it very clear. So if a company lends the shareholder 1 million and it has a year end of 31st December 2023, if the company pays off that loan by 30th September, so 9 months and 1 day after, there is no Section 455 charge. Otherwise, it's a 33.75% charge, which the company is due to pay 9 months and 1 day after, so 1st October. If the company then pays it in between 1st October and 31st December, a refund's due by 1st October 2025, so 9 months after. There's a bit of a cash flow issue here. And if it's repaid in the accounting period after, then the refund's due 9 months after. So for the avoidance of doubt, the charge only applies once. It's not a yearly charge, so it just applies on the amount of loan outstanding. 9 months or 1 day after the accounting period. So if you go on to the next slide, there are instances where there's an exception to the charge, and the most common one that we see this applied to is full-time employees of the company. So if the loan amount outstanding is less than 15,000 and it's an employee that has a less than a material interest in the company, so less than 5% shareholding, there is no Section 455 charge. And if the loan's made in the normal course of the business, so for example, a bank lending, there is none, and to loans to a charitable trust. So Chris, over to you to talk about more nuanced details.
Thanks. Next slide, please. Right, okay, there's a few things to point out here. The 455 is the general rule around making an advance to a participator or a partnership or without things like that. But there are some additional circumstances where a charge can apply. Section 459 covers arrangements where a loan is made by a company to any other person, as a result of which a payment is received by a participator. Now, this is very where we see this most often is in NewCo in management buyouts, where we, if you recall how they work, you put if a shareholder's trying to exit, you put a new company over the top that buys the shares off everybody. The remaining shareholders receive shares in NewCo and the Share Exchange will apply for them. And the exiting shareholder basically receives cash left outstanding for their shares. Now, ordinarily, what we'd like to see is that the original company can dividend up spare cash to the parent, to its new parent, in order to satisfy some of that outstanding consideration, and that's fine. The problem comes if it doesn't have enough reserves to make the distribution, it has to lend it up. So it has to lend money up to the holding company, which is then used to pay the participator. To pay the exiting shareholder. If you remember, participator includes loan creditors. So the exiting shareholder, they don't own any shares, is still a loan creditor, so still a participator. So we do sometimes see that as an issue. Now, that said, the CIOT has very recently, like in the last 3 months, 4 months, written to HMRC to ask them to clarify this point and to ask them, it's not fair and should it be applied? So watch this space. There hasn't yet been a response. I was speaking to someone, one of my colleagues who sits on the CIOT board that wrote the letter, and they haven't heard back yet. But just watch this space because we might hear there might be something coming back soon. 464A is another bit of legislation where it does apply in anti-avoidance situations, but it basically looks at if rather than if loans are being advanced, if there's some sort of benefit received by this participator result of a tax avoidance arrangements. Now, this is where they've announced some changes in budget 2024 for this one. Draft legislation is out. And it took me a while to get my head around when I was reading it all through. But basically, the original drafting of 464A included a number of exceptions. The exceptions were included in 464B and to a certain extent at the end of 464D. And basically, the new legislation, is basically removing those exceptions. So it's going to be much harder to avoid 464A, to fall outside of 464A now, if the participator is receiving any kind of benefit as a shareholder. So it's just something we need to be mindful of. Is that's all changed? Right, what else we said? Right, okay. Other points to note. These shouldn't take long. Right, the first one is that each loan is separate. So if you've got 3 loans, they're all considered separately. If you've got loan and on the other side you've got there's a credit balance sitting in the thing, so you are also owed money, then you cannot set them off when calculating the 455 unless they are actually set off against each other. So everything's thought about in isolation. That said, the revenue do treat it collectively, all the loans collectively, when they're calculating the charge. So in practice, it doesn't make a lot of difference other than the debit credit side of things. To the extent a participator is an associate or director, is a director or an employee, there will be a benefit loan. There will be a loan interest charge, benefit kind loan interest charge, if they're not paying the beneficial annual interest rate. Right. Okay. And yeah, this last point is we sometimes in this profession we come across cases where someone didn't realise they had a 455 charge to pay. As a general rule, HMRC, if it's not been repaid, they actually will want the money plus interest from the date it should have been paid. If the refund date has passed, though, they may simply ask for interest. They can be pragmatic in this way, but they will always be looking for at least the interest to be paid. But there's none of these agreements where they say, "I'll just pay the interest and don't worry about paying the tax." That just doesn't happen these days. Next slide, please. Right, a few points on liquidations. We had Sadiq and I had some discussions with our liquidator team, in-house liquidators team, because there's been an apparent change of policy by HMRC over the last few years. Essentially, HMRC will now apply the Section 400 rules as written in statute, even in liquidations, companies in liquidations. So examples where we've had some issues in the past is the liquidator didn't mistakenly make the distribution to clear the loan before the 9 months after their appointment, which meant that a 455 charge was then applied, and they had to pay it over. And even if they cleared it, a couple of days later after the 9 months, they still have to wait another 12 months before they receive the refund, which delays the whole process. So it can cause a problem with delaying and such like. There used to be a time when HMRC would accept. You could always say, "Look, we can confirm all of our taxes are paid. Can you just return us the money?" And the revenue would. But those days have gone. They just don't do that now. They expect it. I've also seen letters from the revenue to liquidators that turn around and say, when you're, if you were to dissolve the company before the tax becomes payable, this tax debt goes to the Crown. It's bona vacantia. So it is very careful. They need to. I say it can very much delay the process. Right. Next slide, please. Right. Okay. Settlement of loans. The 455 charge is repaid if the loan is either waived or it is repaid. So when the loan ceases to exist, that's what triggers the repayment of the loan. So what can be done? First one is you can simply pay it. The participator can repay it. However, that is subject to 30-day beneficiary rules and arrangement rules, which I'm going to go on to the next slide. So I'm not going to go into those here. So basically, you can repay it. You can credit it with. You can actually declare a dividend or a bonus and actually credit it to the DLA the loan account rather than pay it out. And that actually would not be that would work as a payment, but it wouldn't be subject to the 30-day or the arrangement rules. So it's quite a good way of doing it. Although obviously you've got to pay income tax on the payment. Releasing the debt. This is right. Ordinarily, if a company were to release a debt to such that the value passes out to the shareholder, the dividend there is a distribution to the shareholder, and the shareholder will pay tax on it. This applies. I don't know if you've seen my tax journal article in company where two companies, a loan is released between two companies. It could be a distribution to the common shareholder. Same principle applies there. However, the Section 415 or TOIA overrides the taxing provisions that it's taxed on the shareholders. It is actually taxed on the participator, who is not necessarily a shareholder. It might be an associate of the shareholder. So it's just one of those oddities. 415 is specifically there to make sure the person being taxed on the waiver is taxed as a dividend is the person who took the loan. It's the participator and not any but other person. So that's the specific aim for 415. For NIC purposes, actually, the 415 specifically overrides the employment tax provisions. It's written in the employment tax legislation that it doesn't, that the loan rules, the loan write-off rules doesn't apply if 415 does. However, there's no such exception to the NIC rules. So if the participator is an employee or director, the write-off will be subject to NIC. All right. Next question is sometimes the debt can be assigned, transferred to another person, and there's a question about whether or not this would constitute payment or release, and it depends on whether or not the loan is assigned or novated. If it is the borrower who's changing, it has to be novated because it needs to have the agreement of the lender for a different person to accept the debt, because the other person may not have the same creditworthiness as the first. So they have to agree that yes, we're happy for this other person to be the one paying us rather than you. So novation, and the Revenue are very clear in their guidance that novation of debt is a release of the original debt and the creation of new one. So if the debt is novated, that should trigger a repayment of 455 charge. Yeah, the new loan might also then trigger a new period for a new 455 charge. 9 months after this accounting period, but that's a separate issue. Key point is novation is a release. The problem with assignment of debt is just between the lenders. It's such like it is not necessarily a repayment or a release. It all depends on exactly the terms of the agreement. It could be the case. It's commonly the case where simply the same debt applies. It's just it's just payable to a different person. And that if the company assigns the debt to a third person, let's say it assigns it out to a shareholder or another company, the key point is, having assigned it, it's not been repaid. There's no money ever going to come back to the company, so the debt is never going to be repaid, which is the trigger for getting repayment of 455. So it could mean the 455 is never repayable if debts are assigned. So when we're moving 455 debt around, we have to be very careful with the legals of how it's done and such like. And so there is some relatively good guidance that can be used by the lawyers. Next slide, please. Right, I said I was going to go through the repayment rules. Right, okay. There's two sets of rules which can change, which can affect the repayment, or have we got a repayment, or is it treated as repayment? I should say, for some bizarre reason, and I can't get my head around it, the budget 2024 changes. They've moved this legislation. They've moved it out of. They used to be held in a separate chapter, Chapter 3B, and they've actually moved it into the same chapter as the Section 405 itself. I'm not sure why. It seems to, but that's what they've done. I think they just wanted it all self-contained tar. So there we are. But that's the fact. It's moved. Almost word for word, apart from the arrangements bits has changed slightly in regard to 464A. Right. The 30-day rule, it's very simple. It's very similar to for the share identification rules. If you repay money and then take another advance within 30 days, the repayment is matched against the advance and not the original debt. So you're not treated as repaying the older debt. It's very simple. But as I've mentioned earlier, to the extent the repayment is made out of income that has been subject to income tax already, so from a dividend or a bonus declared by the company, then that will override this 30-day rule. Right. The arrangements rule is a bit broader, and it is very broad. And it's sought to try and it's there to try and stop people circumvent the 30-day rule by sort of just coming into arrangements with other people. So, for example, If you were to borrow money from a bank for 40 days, use that money to clear your 455 debt, and then 40 days later, take a new advance from the company to repay the bank loan, that would fall within these rules. So it's all around, it's trying to stop people from circumventing the bed and breakfasting, circumventing the repayment rules. And it's quite broadly drawn, and it's quite difficult to get around these days. So yeah, so that's where we stand there. And again, it is though overridden if the payment is from an income tax or from dividend or salary. Next slide, please. I think is Q&As. There are a few Q&As popped up while I was talking, so I don't know if I've answered. Let's run through them, Jeff, and see if I've answered.
Yeah, there are 3 Q&As. The first one, I'll just tell you what they are verbatim. The first one is, what is the new TAR, TAAR, post 30 October 2024?
Right. Okay. I did mention that. I think that came in before I mentioned it. It's basically they're making changes to make it far harder to get through the 464A arrangement conferring benefits on participator rules. So they basically removed all the exceptions. So it's going to be much harder to fall outside of the charge if you are receiving a benefit. Right. Next one.
Okay. The next question is, I think, a fairly straightforward one. If a loan to a participator is partly repaid, for example, 50% of it repaid, can a 50% refund of the Section 455 tax paid be claimed?
Quick answer, yes. Yes. Partial payments, it's the amount that's been paid that triggers the refund. So yeah.
So that's a straightforward one.
Yep.
The final question is this. Will the dividend paid up be tax-free in the holding company? This is where you've got the holding company above the original one, even though it could be seen as an abnormally high return for the short term that the holdco is a shareholder. This is a question about dividend exemption.
Yeah, this is about the new co-MBO route that I was describing. Yeah, the answer is yes. Part 9A, which is the expense distribution rules, would apply in this situation. One point to note is that also that would apply would be the depreciatory transaction rules, which means that if there is then a sale of the acquired company, which obviously is now worth less, so you'd expect there a loss to be made if you were to sell it immediately, then to the extent you have withdrawn profits from pre-acquisition, any loss that you make on the disposal of those shares will be restricted by the amount of the depreciatory distribution. So if you took £1 million out, basically any loss you make on the shares would be reduced by £1 million, effectively meaning that you can't create an artificial loss by stripping out assets from a company. So but yeah, broad. So go back to the actual question. Yes, the Part 9A rules would apply. It's not an issue. We've done it many a times. The revenue don't have a problem with it. So yeah, there is a fourth question, by the way, Jeff.
I haven't seen the fourth one. Let me just look at that. Oh yes, there's a new question, which says someone who is not considered an employee or participator and has taken an interest-free loan, say a friend of the director, so not a connected party, does Section 455 apply and benefit in kind apply? And if written off, is it then taxable as a dividend?
It's a good question. This is one of those I think the starting position is with these sort of questions. When I get these sort of questions to tax time, the starting position is, why would you do this? If you can work out why someone's going to do this, you can normally work out the tax. So there is there's also the overriding legal requirement for directors to not play roughshod with the assets of its company, and it can't take action which is detrimental to the shareholders or the creditors. So this sort of thing, I would be saying, yeah, speak to the lawyer before you actually go ahead with something like this. But if a loan is made to a third party, and it's not in the normal business. It's not a bank. It's not a lender of money, but it's still lent over. Then there's a question about, is it a loan to the director who's then lent it on? In which case we might fall within 455 and benefit in kinds, because we've got to work out what is the motivation. If it is generally a third party, interest is being paid, it's an investment in this other person's business, or another company, then that might be fine. If the loan is waived, then there is that question about, is there a connection? Could that be a distribution to the? It's certainly not within 455, so it wouldn't be taxed on the beneficiary for the recipient, but it could be deemed a distribution to the shareholder, to the director shareholder who allowed the loan to be made, because what we've got to think about is often dividend. If the question of is the dividends often looks at is there some gratuitous intent? So if there is a gratuitous intent by the directors to pass this stuff out, then that might well be deemed to be a distribution, and it might be a distribution to him. Could be deemed as a benefit in kind on him. Certainly would be if it's a family member of him. If, aside from the 455 stuff, things, if a relative of a director receives a benefit from the company, it's normally taxed on the director, isn't it? So there's that question about, is there that link there? So I think I would honestly say one of these things, it's possible, but I suspect if someone is going to put an arrangement like this in place, there's normally some other motive there. There's some other link there. There's some reason for this. Is it a thank you for some service? Is it this, that, or the other? Until you can work out exactly that reason, because people don't do this. People do not give assets away, really, except for family or charities. Anything else is normally a reason for it, and you need to explore that, and then the tax will probably follow from that. So
Okay.
the answer is possible.
Okay. I think the answer, Chris, is well that you might want to take legal advice before getting into an argument with the inspector on that one.
Well, exactly. Yeah.
Okay, if there are no more questions and answers, can we have the next slide, please, to finalize? That's us. If you need to contact any of the tax line or VAT consultants, there are contact details. There are the contact details of speakers. And I think that brings the webinar to an end. I hope you all enjoyed it and found it useful. We will be sending out the invites for the February webinar in due course. And thank you all for attending.